Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Dave Lucas with us, and Dave, it's great to have you because we are going to get a primer, a 101 on triple nets today. So Dave, it's great to have you. Can you just kind of explain how you got into this business?
Sure. Bruce, thank you so much for having me on the show today. Big fan of the show. Listened to a ton of the episodes. So excited to be here. I was raised in Pacific Grove, California, down on the Monterey Peninsula. Went to St. Mary's College here in the East Bay during college. And when I got out of St. Mary's, I went to work for Morgan Stanley for the first couple of years out of St. Mary's. Didn't enjoy securities as much as I enjoyed real estate, hard assets, etc. Was fortunate through friends and a couple lucky occurrences, if you will, to be pointed towards Marcus and Millichap at the beginning of my career. Started working with a broker there in 2003 and was with Marcus for about 7 years. Was in the San Francisco office and the Oakland office. Great time, as you and I talked about before the show. Just a great training ground firm. Still have a lot of close relationships at Marcus. Left Marcus in 2008, right as the market was turning. Knew that I wanted to really focus and stay vertical in the retail investment sales market, shopping centers, triple nets, etc. Went to work for Capital Pacific. Bruce, I'm not sure if you know those guys.
Yeah.
Went to work for Capital Pacific in the San Francisco office. Was there for 15 years.
Oh, wow.
At Capital Pacific. Went in there kind of as a regional Northern California investment sales broker. Capital Pacific was historically a national net lease shop. So really went national during my time there. Went with a lot of single tenant brokers to other states to sell shopping centers, which is, one of my core areas of expertise. Was there 15 years. COVID shook up sort of everybody's life, as we know.
Yeah.
I live here in Lafayette and had commuted to the city after I got married and had my two daughters, I think for about 7 or 8 years. And, one of the loyal BART riders for all that time. And when COVID hit, I set up shop out here, rented an office, actually the office that we're in now, kind of built a team here. And then in early 2024, decided it was time for the next chapter and founded and opened Monarch Commercial Advisors. We're a boutique retail investment brokerage company focused on retail investment property, everything from grocery anchored shopping centers down to triple net properties, fast food restaurants, etc. We really try and stay in our lane in retail investment property, occasionally sell other assets. We've got a lot of long-term client relationships here. Occasionally we'll sell something, warehouse office, medical office, etc., but really a heavy focus on retail investment property.
So give us the 101 on, okay, say you're selling your apartment building and now you want to go into triple nets. What are the pitfalls? What are the advantages of doing all this?
Yeah. And as I said, I get this call. I've had 2 this week. I'm selling my apartment building. I'm selling some management intense asset. I want to trade into triple nets. And, we heard they're great. Everybody hears they're great. But they always say, but we've heard a couple horror stories. Often these are referrals coming to us. We sell about 70% of our business is on the listing side, Bruce.
Mm-hmm.
We mostly represent sellers, go out and make a market, push value on sort of all levels of the retail investment property. 30 20 to 30%, because we do a little leasing as well, 20 to 30% are representing buyers. Oftentimes, these are families that are selling a legacy asset. I'll give you an example. I had a family I worked with for a couple of years. They sold a ranch in Colorado. It had been in the family for 60 years.
Oh, wow.
And, they sold it for a huge amount of money. They came to me and said, look, we need triple net 101, which is what we're talking about kind of here today. What do we buy? We want to set up the next generations. This is about capital preservation. We want to also maximize cash flow, but really we don't want to mess up because we're betting the farm. And in this case, it actually was the farm. And so those are the kind of relationships that will work on the buy side, those specific assignments. Some people call and say, I have 3 days left in my 1031 ID period. And I say, I probably can't help you. There is a size limitation necessarily to what we can really create value for. But the triple nets are really, a great investment vehicle. They really are, passive income. And so, my goal today is to share with you some of the ways that, we evaluate these, and look at these. So, did I answer your question? What specifically?
It did, but I think the biggest question that always comes up for me is that we've got this, time period, and we've got to identify, and we have several ways to identify, and invariably, I think people run out of time. I mean, I don't know how often that happens for you. Obviously, you can do different things to make that all work, but how do you skin that cat, so to speak?
Great question, and one that sometimes I get asked too late, so I'm glad you're asking it now. So a few tips. First thing is, and I always encourage people, I'm always a little surprised when I get the phone call that says, tell us about triple nets. And I said, well, what have you looked at? And they might know the definition of triple net. So, the first tip is to go click around on the internet. There's so much information, and I don't mean research what the definition of triple net is. I mean, go on Crexi, go on LoopNet, download some marketing packages, look at what, the investment highlights are, look at what a cap rate is, try and get a little bit of an understanding and familiarity with how these things are marketed. And hey, I saw a 10 cap. Well, that's probably not a good deal, but send it to me and I'll take a look. So, first thing is go do some research, actually look at some deals. Second, and this is always, chicken or the egg type of thing, but try and find a broker that will represent you on the buy side. So you get a lot of first-time triple netters who go out there, triple net buyers who go out there and start calling listing brokers like myself, right? Right now I've got a Dutch Bros, a Chick-fil-A, a Caliber Collision, a portfolio of grocery stores. They call me and they say, I've never bought a triple net before. The reason, if you call me, I'm going to pitch you my listing. I'm going to pitch you hard. I want to know, I want you to know all the great things about the deal. As a first-time triple net buyer, you want someone waving the flag for you on the buy side and saying, hey, that 10 cap, that's not a deal we're going to look at. Hey, your risk tolerance seems extremely conservative. Let's not go towards the shiny object that is a 6.5 cap, 2-unit franchisee or something. You really want someone who says, I like this deal, I don't like this deal. And so, try and find that broker that you can really work with, essentially exclusively. I don't sign exclusive agreements with all my buyers, and some I do. But you want to find someone who's going to wave the flag for you.
So I'm curious, just on that topic.
Yeah.
With the recent new laws in California about the buy side versus sell side and nationally, has that affected things at all?
Are there new laws in California?
Well, yeah.
I'm kidding.
I think
on the
you got me there for a minute. Okay.
On the commercial side, it's less contractual. It really hasn't come over on our side yet.
You're right.
there's no sort of, hey, I represent this person, or hey, I want to pay a fee or not a fee. That really hasn't bled over to the commercial side yet. And the expectations after a couple of years are that it probably won't on the commercial side. So no, that hasn't come up, but it's a really good question. And we all braced when the law passed, but we really haven't seen it at all on the commercial side. For instance, when we list a deal, we have a cooperating fee built in, right? So we're expecting with our clients that they're going to pay a buyer's broker if we don't represent, the buyer direct. And that still, doesn't get challenged. Nobody's talking about the laws the way they are on the residential side.
Right.
Second, or, another tip is get started early. Okay. Don't get to work on this, as your down leg, right? The word down leg, which is the deal you're selling in a 1031 exchange, your apartment building. In the case of our analogy, don't start working on it when that closes or a week before it closes.
Right.
Find that broker or find that deal as you're going to market with the apartment building, right? While you're in escrow, ideally, I want to be making offers and identifying deals as we're about to close escrow on the apartment building. And people still inevitably, put their feet up and say, I have a whole 45-day ID period after this. And I always remind my clients, it's not 45 days to find the perfect deal. You're buying and selling in the same market. We're going to go find a really good deal, but we're going to find a market deal. You're in a 1031 exchange. You don't want to swing for the fences and, say no to everything. And then, as I say, get stuck buying the lesser of three evils, which is what happens to people who on the 45th day submit a list, right? You get three deals on your 10 or three properties in your 1031 exchange. They submit a list of three deals and they haven't even made an offer on one of them yet. It's crazy. Yeah. So use your time wisely, get started in the process. The selling part's usually easy on your apartment building, for instance. It's finding the right deal and getting control of it, before the clock really starts ticking. That is a real advantage.
Do you often recommend for some clients to try and delay or not, try and have the buyer delay close just so that you can identify?
It can be useful. And there are some clients who are looking for a very specific asset and we may not find it. But the motivation, you could kind of graph the emotions of a 1031 exchange buyer, because in the beginning, they're looking for the perfect deal, right? At the very beginning, they're saying, I have plenty of time. I don't like that one. I don't like that one. As the listing broker, I have people circle back, 4 weeks later and say, hey, I actually do like the deal. I know I passed on it before, but now I've seen the market and now I want to buy this thing. So the extensions can be good. They can also be, kind of a curse, in real estate. We have a saying, time kills deals, right?
Oh, yeah.
So, in 30 days, we look at what's happened, just in the last week here. Things can change quickly, right? I mean, things can change. So sometimes they can be advantageous. Other times they can just sort of, delay the inevitable, which is you have to get to work and you have to find a deal.
So what happens, I suspect you've run into this numerous times, where people come in and say, well, I want a statutory trust or one of these other alternate things. I'm sure you've gone through that situation.
Yeah, and I think that the DSTs are good for some clients. You don't have the control, right? You don't have the control, and, triple nets are traditionally more kind of later stage investments. I mean, there's plenty of younger people buying them, but oftentimes, the curve is, work hard, make little cash, on the apartment buildings and management intents to do a lot of work. Often to, later stage investing in real estate is, I want passive income. I don't want to, double my equity in a deal. I want it safe. I've made it. I want cash flow on it. So for that reason, uh, you know, for that reason, you want to find the right deal. Sorry, did I answer the question correctly?
Yes, no, that's great. So my next question is, okay, so you identify a property. Uh, I've heard, I don't know if you've run into this, that say like Starbucks, you think, oh, this is, AAA, great tenant, all this thing, but lo and behold, hidden in Starbucks lease is a out clause.
Yeah.
So
That was another tip, and that is line up your team again early in the process. Your team obviously consists of a broker looking for deals for you. You want to have an attorney that knows you're in a 1031 exchange and you may be sending a purchase and sale agreement, a lease, other due diligence to, a title report, etc. Sometimes we'll get people who who now we found a deal, we wrote a non-binding letter of intent, none of this required an attorney. And I say, all right, let's call your attorney. And they say, oh, I just called them. They're 2 weeks out before they can look at anything, So, line up that attorney, line up your lender, line up your loan broker, and these are all vendors that we have. If someone comes to us and says, I have none of those, obviously we have recommendations in all departments, but you just don't want to lose that week where you just got a contract or a letter of intent signed.
Right.
And the seller of that, right? We're the buyer. The seller said, where's my contract? I gave you the deal.
Hello.
Where's my comments? Here's the contract. Where's my comments? So you just don't want to lose that week. But that's another, that's another tip is get a good attorney. And I've been doing this for a long time. We sell a high volume of deals each year. I've seen it all. And we're going to look at the lease right away. We see a Starbucks. Hey, we know there are some nuances to Starbucks leases. There's a few tenants out there who I might describe as notorious for things in their leases, so we're always going to be looking. But it's just about us, that's about your broker knowing the right questions to ask. Right? Do you have a clean phase one in the property?
No.
We closed a deal last year that someone identified in August and then came back to us begging for the deal in November. Fortunately, we had it available and they said my other deal had a dirty phase two.
Oh,
they did phase one, they did phase two.
Oh, wow.
They came back and had to blow that deal out. So they came back to us on their hands and knees saying, can we please have this deal?
This was a gas station or a...
No, theirs was just a shopping center, and it turned out there was a dry cleaner, and the dry cleaner had a big release, and they ended up having to blow out the deal. So yeah, it really is. You really have to know, not have to know, you just have to move quickly. All right, yeah. And the big thing on triple nets, and I'm always shocked when I hear that people didn't, but the lease is the primary instrument of value on that asset. You have a building, it's well located, it's on a piece of dirt, great. But the reason you're buying it and the reason it's triple net is what's in the lease. Read the lease the second you get your hands on it. And people won't give you leases before you have control often. I don't give out leases if someone just says, hey, can I look at the lease? But it's the document that you want to read through. The broker reads through it, the principal reads through it, the attorney reads through it, and really dig for those pitfalls.
So I'm curious, how often can you get those pitfalls changed or eliminated?
In a lease?
Yeah.
Almost depends, never right? In the timeline that you're in your 1031.
Oh, really?
Yeah, you really can't. Starbucks, we call up and say, hey, you have a termination clause in year 7. It's year 2 of your lease. What would it take to get rid of that?
Yeah.
And, they hang up the phone.
No chance.
The lease is baked and we're not doing a deal with the tenant, right? The tenant's already a tenant there. We're doing a deal with the landlord.
Right.
And so you really have to punt at that stage.
So just out of curiosity, how often do you go ahead with those and say, okay, it is what it is. We can't change it. So you got to decide. You take the
We
termination clause?
we hold everything up to the light pretty early.
Yeah.
And so, plenty of my clients look and say, hey, first off, we should have known that there was a termination clause in year 7, right? And that's probably a bad example because that would be disclosed likely by the broker. But
Right.
I'll give you another one, Prop 13 protection. So in these triple net leases, as you know,
Oh, yeah.
the tenant's responsible for everything, including taxes.
Right.
Some leases, you'll read the property tax section and it'll say, we'll only pay one property tax increase that resulted from a sale every 5 years, right? Yeah. And so, that might be a little bit of a surprise, but let's evaluate it. Let's underwrite it. Let's see how much financial exposure we have to this. And then let's make a decision quickly whether we can live with it. Do we go back and ask for something on behalf of, on behalf of a buyer, or do we punt the deal completely and move on? Clock's ticking in these 1031 exchanges, and not all triple nets are, deals are 1031 buyers, but if there is a 1031, you want this information fast and you want to be able to hold it up to the light.
So that brings me to the ultimate question of, okay, so you get down to the wire, you haven't completed. Is there any way to extend?
No, not legally, I guess. Not legally. And I have a lot of friends in 1031 exchange accommodators that I work with. And, there's rumors of the accommodating accommodator. But, is that worth an audit and, potentially paying taxes? Typically not, right?
Yeah,
Typically not.
Screwed. Yeah.
You need to be real tight. There are kind of 4 main factors that I wanted to tell you, that I wanted to share with you and your listeners on kind of how to do the quick litmus test on triple nets.
This is great.
Right? Some people just look at a triple net and say, what's the credit? You mentioned Starbucks earlier, Chase Bank. We use kind of a, sort of 4 categories as kind of a quick litmus test when you look at triple nets. The first thing we look at is the rent. And is the rent replaceable? In the extremely unlikely event that I lose my tenant and I have a vacant building, can I go get that rent again? Can I get $100,000 a year in rent if that's what the tenant's paying for this building again? Not everybody knows that right away, but if the rent seems really high, the rent's $3 million on a building, right? You sort of look and say, oh, that looks high. How much is that per foot? That's $60 a foot. Even just clicking around on, ChatGPT, you might figure out that that's a pretty high rent. Can I duplicate the rent? So, is it replaceable? Is the building recyclable at this current level? Is it going to hold value? And I'm going to be able to go get a tenant, at an equal or greater rent. And in some cases, that doesn't mean don't buy it. It's just something you need to be aware of right away. Where is the rent relative to market? So we look at, can we replace the rent? Second thing we try and get or ascertain is what's the unit level performance of the tenant at that site. So how many widgets are they selling at 123 Main Street, right? How many burgers, how much groceries, how much coffee? And not all tenants share that information. Some report sales, so we can have it right in front of us. Some we kind of have to dig for. We have relationships, we have software, there are a lot of ways that we can determine work. I think you've all, you've certainly seen Placer AI. We use a group called CenterCheck. You want to know, is this a good site or a bad site specifically for that location? The third thing we look at is credit of the tenant. So if I had replaceable rent and really good store sales at a location, maybe the credit I can be a little softer on, or if I had really high credit and the rent's a little high, but the sales are okay, maybe I can, maybe it just depends on sort of where you are in the risk tolerance curve, to look at those 3 factors. Don't always look just at credit. People see Chase Bank, done. Chick-fil-A is a pretty safe play from a credit standpoint, right?
Right. Yeah.
But the cap rate's going to be aggressive, rent's going to be high, but the credit is absolutely bulletproof. That, the default risk is, lower than the government probably.
So just a quick question. How do you check credit?
So and again, with the AI, you asked me a little bit about how we use AI. There is so much. It used to be kind of click and dig through, Moody's or, the obvious credit ratings, the S&P ratings, etc. But, asking AI, asking ChatGPT, Claude, etc., you're usually going to get, at the very least, kind of a trail of breadcrumbs to follow on, hey, this tenant looks to be solid. We always want to see financials. If I'm buying anything that's not corporate guaranteed or, investment grade, where the onus is really on us as the buyers. If it's investment grade, hey, it's a public company, go, figure it out yourself. Like, you've got a corporate guaranteed lease. There are ways to, dig further on the credit of a tenant. We always want to request financials, but that's part of due diligence. We're selling some deals right now that are great assets, and they are franchisee guaranteed. I'll tell you anecdotally what the net worth of the guarantor is, but I'm not going to share those with you until you get into escrow, and then you can see, two large personal financial statements. Once we're in escrow to validate that, kind of credit and financial strength. But really, you have to dig a little. You don't want to take anybody's word for it. Go ahead.
Do you dig down? Do you actually ask for tax returns or the first 2 pages or any of that kind of thing?
Not so much. I mean, tax returns are kind of a last resort. I want to see financial statements. I want to see a profit and loss statement. And a balance sheet. And, you can usually find out, well, and I guess the fourth thing, because this is sort of relevant here, is if you're buying outside of markets that like California.
Yeah.
Right? I've done deals in 32 states in the country, a lot of which are that. Go try and figure out the economic drivers of a town. Not a deal I sold, but a deal a buddy of mine sold. DuPont was shutting down the factory. They were the largest employer in the county in a town, and he spotted that, halfway through escrow.
Oh wow.
And and blew out the deal. And actually, I think found a deal in the town that they were moving moving the factory to. But you do the demographic profile. If we're around here, if you're buying a deal in California, we can get to 1 degree removed from, who are the principals of a company, what's their history, what other, units or businesses do they own. If you're doing a deal out of state, you want to do research on the area, get a local attorney perhaps who can, dig a little deeper. But this is all if you're, how do I say it? Concerned, that things might not look right. When you get financials and someone represents them as real financials, there's a lot of good faith that still goes into that.
Yeah.
Does that make sense?
Oh yeah, absolutely. No, those are great, fantastic tips. And one thing that some of us obviously have run into, that different states have different regulations on real estate and closing and so forth. So I'm sure you've run into that issue. Given 32 states.
Yeah. And there's some states that are kind of punitive to buy deals in, and others that are, sort of freewheeling. It's really more knowing, and we put a ton of focus and stock here at our company on execution. I remember back at Marcus and Millichap in 2006, I wasn't aware of a pretty big closing cost addition. I think it was Virginia, perhaps. And my buyers were shocked by it. And, we ended up both contributing. But now, we put a deal in another state in contract. We know most of the closing costs. We immediately are in touch with escrow saying, let me run through what we understand. You tell us, is there some, document transfer stamp tax that we didn't know about that's another $5,000 of closing costs.
Do the expediters look at that, or is it the escrow companies that you end up talking to?
It's the escrow company. It's the escrow officer usually. And we have, at this point with our track record of so many years, I could call a preferred relationship in Texas and say, hey, who do you like in Florida? Who's a commercial expert who, has done triple net deals or retail assets, whatever it is, and get to someone who we can, trust to work with and, make sure there are no surprises. Surprises to deals, problems don't, right? That's another.
Yeah. Well, particularly when you're on a time frame, it can make it very dicey.
Yeah, absolutely.
It's dicey regardless, but put a time frame on it, and then you're also screwed. But in terms of identifying, you got the 45 days, but then you've got 180 days to actually close, right?
Yeah, another 135 after that 45 days.
Yeah.
Right. But I mean, really, rarely do you see someone go past, 60 days past the 45 days.
Right.
It is such a tough play. Well, I guess I'll say it like this. Buyers really start to lose sleep, and it becomes, personally stressful for everybody. I mean, we participate in some of that stress as the brokers, because I don't want to be past the 45th day. We've etched our 3 deals in stone, Bruce, and I don't know if the property's environmentally clean yet.
Oh,
right.
Yeah.
I mean, some people just say, hey, look, 30 days in, we found a deal. We put it into contract. We've got, 15 days left in our ID period in that 45-day period.
Right.
And they tell us they don't have a phase 1.
Oh, God.
So now, and it's not uncommon. Some people just don't get them. I sell some deals without phase 1s, and now we have to cross our fingers that there was never a gas station under this site. And I'm not going to get the phase 1 back.
Right.
Until 21 days, which happens to be 6 days after the 45-day ID period. That might be our lead deal. Now we have to go to our 2 backups. So again, I go back to that, and this is where, we're so focused, and this is where, we do our best work. Let's start back on the day you want to list something, right? The day you decide to sell the ranch, the apartments, the office building, whatever it is, let's start there. Let's look at deals. Let's build our, sort of risk profile, if you will.
Right.
And so, the second we get an offer on the down leg on the deal we're selling, we're immediately out looking for deals. Hey, here's the Raising Cane's you wanted. Here's, the Caliber Collision. We've got a, Lucky Supermarket, a strip center, whatever it is that we've identified. We already know what we're looking for. Too many people enter that 45 days sort of saying, we thought about a house in Florida with a little bit of the money, and then, we're going to put 2 over here. And oftentimes these are estate planning decisions that also factor into this.
Right.
I probably won't be around. One kid's a doctor and the other's a teacher. They're not real estate people. I want to get an asset that when I'm not around, that can just spin off cash flow and they can easily own and operate and find me that, So that's important to, build that profile early so we're not out, sort of shotgunning the wayside. Another thing too that I always tell these buyers, Bruce, is it's kind of a shoot first, ask questions later game when you're looking for deals.
Right.
Some people want to go visit them before they make an offer.
Oh.
And I'm like, there will be 5 offers between now and when we visit them. I want you to visit it the day we're awarded the deal, but don't burn 3 days on the road during your 45-day ID period going to see the deal. Let's get control first.
So question. So you've identified your three properties in 45 days. The property one bails out. You can go back to two or three, right?
That's right. That's right. And that's again where you want to make sure that 2 and 3 are deals that you think will be there.
Mm,
Okay. If there's 20 offers on the deal and you go into and that's your backup,
yeah.
maybe we shouldn't use it as a backup. And in some cases, even Bruce, this is where I sort of say, hey, as a safety, maybe we look at a DST for the third. I mean,
Oh,
these DSTs
yeah.
are not all, how would I say it? They're not suitable for some buyers. Like I
Right.
said, for
Right.
sometimes I have a client. They said, hey, we have a few bucks left over. I think they had 400,000 left over in a trade. And they said, we'd like
Yeah.
to look at DSTs. And I said, perfect,
Right. Yeah.
Um, so it's just about identifying a backup that you think will be there. Another benefit of us, we have a pretty deep pipeline of deals that are not yet on the market. So sometimes we'll say, hey, this thing is under construction. It's not even on the market yet. It's a Chipotle and it would be a great asset. I don't think you can buy it now because we still, maybe they're just pouring the foundation or something.
Right.
Let's identify something that will be around if we need it in 60 days, 90 days, whatever it is.
Does anybody ever put more than one property in escrow?
Yes, unfortunately, and
Oh.
and I've been usually they're trying to do it with one of my deals.
Oh.
Um, it's not. It's a bad practice. I mean, usually that person, Bruce, is the same person who went past their 45th day.
Oh.
Selected 3 deals. They don't know anything yet. They're sort of tying things up out of panic. And the good news is the brokerage community, especially around triple nets, especially around Northern California, it's so small that when that happens, you end up on a list. And I ask people, what else are you looking at? Have you tied anything else up? Have you made offers on anything else? When's your 1031 exchange ID date? These are all questions I ask when I'm the listing broker, right? And
Yeah.
so I kind of know what information I need to be ready with on the buy side as well. But it's just, again, that means you've, probably drug your feet and, you're panicking in that case.
Yeah. And I think I don't know what your track record is, but unfortunately, I think a lot of people end up looking too late.
That's it. No, they, like I said a moment ago, you don't think of this as 45 days to find the perfect deal, right? Identify what you want, what type of deal you want to buy, and let's go find a good deal, but a market deal, right? You're selling in the same market you're buying in. So there's no big arbitrage game to play, buy low, sell high, or rather
Right. Right.
sell high, buy low.
Right. Right.
So, accomplish the trade. That's the most important thing. I mean, some people might have a $3 to $5 million tax liability if they don't accomplish the trade. And if it's that type of money, usually people are doing, what I'm talking about, starting way back. We've sort of lined up the team as I talked about, who's our attorney, who's our 1031 exchange accommodator, who will we go to for a loan. We're talking about that 6 months in advance sometimes of selling. A client of mine sold a beautiful mid-rise building in the financial district pre-COVID, and we planned for 2 years on sort of where were we going to go. Here's where cap rates are today. They had offers, but they just said we're too freaked out in the 1031. And we ended up getting them a really, nice portfolio of triple nets.
That's fantastic. So I think we've covered most of the territory. I'm sure there's other questions, but I suspect that if a listener wants to contact you and they've listened to this particular podcast, where can they get a hold of you, Dave?
My website, monarchcommercial.com, and my email, dave@monarchcommercial. would love to hear, talk more, and find out if there's an opportunity for us to work with someone, work with the potential listener.
I think there's lots of people out there that are looking for this particular item.
Okay,
So
good. We're ready.
Let's keep in touch. Obviously, the world is going through some interesting things right now. So I think we may want to talk again in 3 months and just kind of see what's happening out there in the market.
Yeah, I look forward to that, Bruce. Really appreciate you having me on today. Like I said, big fan. Thanks again. And we're definitely going to stay in touch.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.